Hello everyone, welcome to episode 7 of Big Deal Real Estate. Today what I want to talk about is how to pay off your mortgage early. So in all three examples, I'm going to be using a mortgage for $200,000 at 4% with a term of 30 years, which pans out to about $955 per month. So jumping right in, example number 1 is to make an extra mortgage payment every year. Meaning you get to the end of the year and you make 2 mortgage payments in December instead of 1. Now, the way that works is if you were to do that, it's going to save you about 4 years on your mortgage, meaning you pay it off in 26 years instead of 30, and it's going to save you about $19,000 in interest. Now, this is $19,000 you're not paying the bank, it's $19,000 you're saving. And the way it looks on a graph is this. Remember in the past what I talked about is debt amortization, how in the beginning of your loan most of the mortgage payment is going to go towards interest and very little of it is going to go towards principal, and it's going to be like this kind of correlation over time. This is just the principal over time. I don't have the interest graph because we don't need to in these examples. So the way this one works is it starts out the same, but it follows the same kind of correlation, like, oh, you make an extra mortgage payment, oh, you make another extra mortgage payment, oh, again, and you just keep doing that over the life of the loan until you're down to 26 years now. Nothing's going to be drawn to scale, guys, so bear with me here, but I'm sure you guys get the point. So that's the first way that you can pay off a mortgage early. Now, the second way is to make an extra payment every month. So this one goes off the same principle as the one before it, it's just a little more aggressive. How this one pans out is if you were to make 2 mortgage payments every month, the first one would be, at the beginning of the loan, would be all interest, some principal, and then the entire second mortgage payment would be all principal. It'll save you 18 years on your mortgage, with these numbers. And, well, actually it doesn't matter what these numbers are. If you consistently are making your mortgage payments and make 2 mortgage payments, the time is always going to be the same. And it's also going to save you about $85,000 in interest. So again, if you can pull off this method, you're going to pay off your mortgage in 12 years and you're going to save $85,000 in interest. And again, on the graph, it starts out the same. It's just a little more aggressive than the last one. And every month you chunk it down a little bit. I'm not going to draw the little lines. It's just going to be a correlation that kind of looks like this, rather than the longer one. So that's the second way to buy down a mortgage quicker. So here's the third way, guys. This method is called velocity banking. And this is definitely the most aggressive way to pay down a mortgage that I've ever seen. If you want more information on this topic, Google it, look it up on YouTube. There's much more detailed videos on how this shakes out. I'm just going to give you the gist of it. I'm no financial planner, I'm no financial advisor, so before you apply this method, make sure you seek legal advice and financial advice. Because again, this one's very aggressive and I only know a select few of people who actually can pull this off. Jumping right in. So let's say you're a person that's making $60,000 a year on a fixed income, or $5K a month. And you have a credit card with a $15,000 limit on it. And we'll say 22% interest. So we're applying the same principles here as what I talked about before. And what you're going to do, what I've seen people do, is they take this $15,000 limit on their credit card and they buy down the mortgage that much. So as soon as they close on a $200,000 property, they use a credit card, make a $15,000 down payment. Well, not a down payment, but they use $15,000 of it to buy down the principal down to $185,000. So what you're probably thinking right now is, what the heck, Kyle? Why wouldn't I just pay 4% on that 200,000 rather than paying 22% on this $15,000 credit card? So what I've seen people do is they take the $15,000 balance that they used to pay down the mortgage and they pay it off over 6 months, which is about $2,500 a month, which is doable if you're making $5,000 a month. Because, and I've checked the math on this and it does check out. 22% on 15,000 over a 6-month period is a hell of a lot less in interest than 4% over 30 years. It's compounding interest. That to me is the 8th wonder of the world, is compound interest. So the people that I've seen applying this method pay off their mortgage in 5 years because they chunk it down to, with that 15,000, they pay it off in 6 months. As soon as it's paid off, they chunk it down again, and they just keep doing that and doing that. And the way it works is, it's obviously a little more aggressive, and it just keeps dropping down like this until, this isn't to scale, but, just bear with me. And that's how they pay it off in 5 years. So I don't know the exact amount in interest you would save, but because obviously you're going to be paying interest on that credit card over that amount of time, but I can tell you right now it's going to be a hell of a lot less than 4% over 30 years. So again, guys, I'm no financial planner, I'm no financial analyst. If you want to apply this method, go ahead, but I'm going to tell you to seek legal and financial advice, because this one you definitely need a lot of discipline to use, and again, I've only seen a few investors pull this off. So yeah, thanks for tuning in, guys. Make sure you like, share, and subscribe for more content.